Auditors seek to understand internal control for two main reasons. First off, they need to make judgments about the evidence needed for a financial statement audit. Remember, during the risk assessment stage of the audit, they're trying to gain a general understanding of internal control, which they're going to use to try to figure out whether they want to test controls further during the risk response stage. Also, auditors for a public company audit are required to evaluate internal control and issue an opinion on it. So, with a public company audit, that's a second reason why we need to look at internal control. So, we see here there's kind of a flow chart of the different steps auditors go through when they're seeking to evaluate internal control. And notice the first step is understanding this at an entity level. So remember, we talked about the difference between entity and transaction level controls. We're going to go through and talk about each of these steps over the next two chapters. In this particular section, we want to focus on those 5 components of internal control and the 17 principles that guide good internal control policy within an organization. So the first component we're going to look at is the control environment. And this is basically the tone set by management that influences the consciousness of the employees within the organization. So this is a high level overall entity level control. And it's a combination of the culture, structure, and discipline of the organization. So we see here the first of the 5 principles. Overall, there's going to be 17. So each of these 5 components has a number of principles associated with it. The first one is the organization demonstrates a commitment to integrity and ethical values. So when the auditor is trying to gain this understanding of internal control, they're going to look at each of these 5 components and dig deeply into the principles associated with each of the components. So for instance, a piece of evidence auditors might find to validate this first principle to show that management does have integrity is they could ask themselves, is there a hotline directly to the audit committee, right? So if there's issues that spring up within the organization regarding internal control, do managers at lower levels of the organization have the ability to reach out with a hotline to folks on the audit committee? This is really important because this helps them maybe circumvent layers of management that maybe will dismiss their issue that they have with the functioning of internal control. And also on the level of the board of directors, the second principle, we want to make sure that the board of directors actually are independent from management, all right? And they actually exercise oversight over the deployment of internal control. So one way auditors can kind of measure this is to see if the board of directors actually has interactions on a regular basis with their auditors. If you're taking on a new client, remember, during the process of engaging with a new client, you reach out to their predecessor auditor. This is something you could ask them. Did you have good communications with the board of directors? Did they communicate with you frequently? If not, that might indicate that they're failing somewhat on this second principle. The next 3 principles are kind of in regards to high-level HR type policy. Number 3 is making sure that management establishes proper structures and reporting lines in regards to internal control. So a big part of this is delegating authority as needed. We don't want to give folks more authority than necessary. So if you think about a physical control, for instance, the safeguarding of maybe inventory, we don't want to give every employee in the company access to the warehouse or the area where we store inventory. We only want folks that actually need access to that inventory to be able to get into those secure locations. That's an internal control to help us safeguard those assets and putting that internal control in place makes it less likely that we're going to have employee theft of inventory because only certain folks can actually access those areas. So management also wants to attract and retain competent individuals for their particular job roles, just like we talked with auditors, right? There's we need to have competent people working on the audit team, and same idea with management. The management within the company All right, that's a good internal control. They only hire people with the necessary skills to actually perform job duties. If management goes out and hires somebody with no accounting background to be a staff accountant, that could be problematic. That could lead to issues with journal entries and whatnot. So that's going to be a problem within the company. That's a higher risk that the financial reporting is not going to be accurate. And we also want to make sure that the organization holds individuals accountable to whatever policies they put in place in regards to internal control. We could set up all these great internal controls, but if people violate the procedures and management does nothing about it, the internal controls really aren't going to do much for our organization. Now, the second component is risk assessment. And basically, the risk assessment process on the part of management is them looking at all the objectives of the organization and identifying any risks to those objectives. So if you recall, we talked about the risk assessment on the part of auditors, that they go out and they try to assess any risks within the company. All right, this is a little bit separate. Management does basically a similar process. So auditors actually have a risk assessment of management's risk assessment. But right now we're talking about the principles that management is supposed to uphold. So we could see here principles 6 through 9 kind of relate to this risk assessment process. So first off, in principle 6, the organization needs to clearly specify its objectives, right? So one objective might be to have our manufacturing line to operate effectively and efficiently. So there's different internal controls maybe in place to try to prevent waste and scrap on the manufacturing line. So that's an identification of one particular objective. Another objective is that management wants to have good financial numbers. They want their financial accounting information system to work properly. So there'll be a number of different controls put in place to oversee that. So once we know what the objectives are, then we can analyze the risks to us not achieving those objectives as managers. So for instance, a security threat maybe is a risk to that manufacturing process. Maybe they identified that there's some type of issue where their systems could be hacked into and somebody could hack into their manufacturing plant and shut down production. All right, well, that risk is going to kind of put their initial objective of efficient manufacturing in jeopardy. So after they find out all the objectives for the company, they want to look at the individual risks associated with those objectives. And number 8 gets to the issue of fraud. Just like auditors need to make special focus to look out for fraud, good internal control practices require that the organization considers potential for fraud and tries to mitigate that through the necessary internal control processes. The last principle associated with risk assessment is that the organization identifies and assesses any changes out there, whether it's external or internal, that can impact the system of internal control. So one example would be maybe a company is growing rapidly. Let's say they're a retailer and they sell inventory. So if they're growing rapidly, they might be concerned that they're going to have issues with employee theft. They're expanding operations. Maybe they're going to open up new warehouses. So they need to think about that change, that expansion, and what type of internal controls they're going to put in place to mitigate any risks associated with that new business activity. And this leads us to the third component, control activities. These are basically the policies and procedures put in place to try to mitigate against those risks. So the organization wants to develop control activities to try to make risks acceptably low for each of the different objectives that they identified in the risk assessment component. So for instance, when we're thinking about that situation where the company's expanding, right? They're selling goods, maybe they go from a regional to a national retailer. So they have warehouses and inventory stock all over the country. They might want to rethink about how they control inventory. That could be physical changes. Maybe they add more workers to do more physical counts to keep track of inventory. Or it can be through the use of IT. right? They could develop new software systems or applications that help keep track of inventory. That would be kind of associated with this principle number 11, developing control activities over technology. So you could see these different components are kind of interrelated with one another, and also the principles that follow each of the individual components, they're interrelated with one another as well. Number 12 here is the organization wants to put into place policies and procedures that helps to make these control activities as efficient as possible. So we're going to look at our objectives, analyze the risks, and then we're actually going to put the policies in place to try to mitigate those risks. So one particular issue with companies is the segregation of duties. So imagine the function of purchasing within a company. You might have a purchasing manager that signs off on purchases. All right, let's say we're talking about purchases of inventory. And then you might have other individuals within the company that actually receive the goods and actually track that the goods that were purchased arrive in the company and we have that inventory. And then you might have other individuals that maintain the records, right, regarding those purchases. So we don't want the same person or the same department in charge of all these functions, because that leads to greater likelihood of fraud. So basically, it's good internal control to have proper segregation of duties. So this is one of the ways that we kind of go back and put principle number 12 into action. Information and communication is also key within the company to make sure that internal control practices are running effectively. We could see here that we have another 3 principles surrounding the information and communication component. Number 13 talks about the need for relevant data. So an example of this would be maybe our HR internal controls over collecting data from employees. There might be different statutory regulations involving collection of employee data. Think, for instance, we have to remit payroll taxes to the government. We have to have withholding taxes. So we need relevant information. We need timely information, for example, about our workers' dependency status, right? We need to know how many dependents they have so we can accurately withhold the right amount of money from their paycheck. So we want to make sure we have relevant data so we're able to actually do that correctly and uphold our obligations on that end. Also, we want to make sure that we have good communications, not only internally, but externally as well. So an example of good internal communications would be different types of training. For instance, an important objective for many companies is to try to have a safe workspace where all employees feel valued and they feel safe. So a company, for instance, may put in place training for safety. They might have like sexual harassment training. So these different types of training help communicate to the employees not only the importance of these issues to the company, but they communicate to the employees how they go about properly handling these different types of issues. When we're talking about external communications, these could be different communications between the companies and their vendors, customers, different entities like bankers, lawyers. An example of this, a good internal control policy in terms of external communication can deal with sales to customers. Whenever we have maybe issues with returns, it's good internal control practice to let the customers know who they can contact when they have an issue with a product that they purchased. And typically, we don't want them contacting the same person or department within the company that sold them the defective product. It's better that we have some type of helpline that they go to that's separate from that department. All right, and that way, that's going to help us catch errors. People aren't going to sweep things under the rug, because if somebody in the department who made the error is in contact with a customer, they might have an incentive not to really follow up because they don't want to get themselves in trouble. So that's a good internal control practice with our external communication with outside individuals, in this case, customers. The last activity we're going to look at, the last component, is monitoring activities. And this is basically kind of assessing the quality of internal control. So going back after the fact and looking at how well our internal control is actually operating. So number 16 is referencing the fact that organizations want to select, develop, and perform these ongoing evaluations, and having a strong internal audit function within a company helps to foster this. So if we have an internal audit function, this is going to be one of their big responsibilities: overseeing internal controls, testing internal controls to make sure they're actually functioning as needed. And then the internal auditors can kind of look at things and determine if the company needs additional controls or any fixes on the existing controls. Number 17, our last principle, is basically looking at how the organization evaluates and communicates internal control deficiencies. So, for example, exception reports kind of fall in this area. Maybe we have, again, a company that does manufacturing, and they have reports showing how much waste we have with the manufacturing process. Perhaps there's spillage or leakage or some issue like that. And if we were looking at these reports, there might be an acceptable level of spillage, for instance, during the manufacturing process. Let's say we have a manufacturer that has little beads that come in, plastic beads that they melt down to create some sort of plastic product. Well, if we have millions and millions of little beads being used in this process, some are going to get lost, spilled over, whatever the case is. So management might have reports drawn up showing, how much spillage we have each hour or each day. And then you can kind of look for exceptions. We could see if we had like one day where there was a really bad situation where there was a lot of waste along the manufacturing line, and then we want to kind of follow up on those exceptions. If we run these exception reports and do nothing with that information, then we're kind of violating principle number 17. We're not really evaluating the internal control that we put in place, right? The spillage report, the exception report, was the internal control put in place, and that's great to have, but if we're not actually following up and using the internal control, it's not really providing any benefit to our organization.